To hedge or not to hedge? That is the question that every single investor should ask themselves before buying international assets in their portfolio. Because when you send money overseas, you're exposing yourself to currency risk. This exposure to foreign currencies can act as both an opportunity and a threat in your portfolio. If you get the currency play wrong, then it's going to detract from your overall return. But on the other hand, if you get the currency play right, then it can add to your overall return. Hello guys, Brad here from The Guided Investor. Welcome back to the channel where I help you do more with your money. And today we are talking about hedging. Hedging is a tool that can be used to reduce the effect of exchange rate fluctuations in your portfolio. So the aim of hedging is that the portfolio is affected by changing asset prices and not by changes in currency. If you're not implementing a hedging strategy, then you're said to be unhedged. And this basically means that you are short the Australian dollar and you're long the foreign currency. Or put another way, when you buy a foreign asset, you sell out of Australian dollars to buy that asset in the foreign currency. And as the investor, you hope that while you're holding that foreign asset, that the value of the Australian dollar drops. So later on, you can sell that asset and buy back the Australian dollars cheaper than what you sold it for. Deciding when to hedge can be quite a difficult decision to make because at the end of the day, there are many factors involved in determining currency fluctuations. But 5 of those key factors are as follows: interest rate differentials, commodity prices, purchasing power parity, government credit ratings, and sentiment and speculation. Now, I'm not going to go into those 5 things in detail because there's a lot of complexity involved in every single one of those. But what I will say is that sometimes it's beneficial to have a look at the long-term average of a currency play and compare it to where it's currently sitting. So, for example, the 30-year average when you're comparing the Australian dollar to the US dollar is around 76 cents. Now, earlier this year in March, we saw the exchange rate was sitting around 58 cents, and so we took the view and the opinion that the Australian dollar would rise from there. And as a result, we hedged our portfolio. Turns out we were right, and the Australian dollar is currently sitting around 70 cents. So this means that it was a good play for us to hedge our international exposures because we didn't lose portfolio return as a result of the rising Australian dollar. But of course, and this should go without saying, looking at the historical averages is not gospel. It's merely an indication, but it doesn't necessarily mean that things are going to happen exactly the same way in the future. When deciding if you should hedge or not, you should also take into consideration your tolerance to risk and your experience as an investor. Because at the end of the day, when you introduce currency into the portfolio, it adds additional risk and it adds additional complexity. So if you're not very experienced or you're pretty risk adverse, then your default should be to keep your portfolio hedged to eliminate that currency risk. There are a number of different ways that you can hedge your portfolio. And if you want to do it yourself, there's a number of different tools available to Aussie investors, including currency ETFs and foreign exchange derivatives. Now, these start to get a little bit complex and it's not my preferred way to hedge my portfolio. Instead, I like to get my international exposure through a combination of passive and active funds. Now, generally, when you find a fund you like, there's often 2 versions of it, a hedged version and an unhedged version. So you simply pick the one that is in line with your outlook on currency. Some active managers will also actively manage the exchange rate risk in the portfolio based on their own personal outlook. Now, as an investor, this is great because the job's done for you. You don't have to decide if it's hedged or unhedged. The manager does this. But the downside is that the manager's view might differ to yours and they don't always get the call right. It's also important to note that if you do take a position in a hedge fund, then the management expense ratio, or the MER, is likely going to be slightly higher than it is for the unhedged fund. And this is simply because there are costs involved with hedging the portfolio. To give you an idea of the importance of hedging, let's look at a little example. And we'll take the Vanguard International Shares Index Fund and compare it with the Vanguard International Shares Index Fund hedged, so VGS versus VGAD. Both ETFs track the exact same index, and that is the MSCI World ex-Australia Index. Now, the only difference between these two is that VGS exposes you to currency risk and VGAD does not. Over the last 12 months, for the period ending 30th of September 2020, VGS returned 4.37% and VGAD returned 6.43%. So as you can see, even though the underlying holdings of these two funds are identical, there's a difference in the performance of 2.06%, which is quite significant. So over the last 12 months, because the Australian dollar has risen, you would have been much better off hedging your international exposures. Now, I'm only using VGS and VGAD as an example. This is not a recommendation to buy one or the other. When deciding what to buy, you need to do your own research and make up your own mind. I'm a big fan of investing internationally because there's some offshore opportunities that we just can't get through investing in Australian companies. However, when you do invest overseas, you have to take into account your foreign exchange risk. It's also important to note that sometimes you can't hedge away your currency risk. So for example, if you invest in an Australian listed company that does a lot of its business overseas and exports a lot of products, then its revenue is likely going to be pretty sensitive to currency movements. So in this instance, you can't hedge away from that, so don't really bother about it. When you do have control over the currency, I personally like to play the extremes. So when I think the Australian dollar is well overvalued, then I'll take an unhedged position. When I think the Australian dollar is well undervalued, I'll take a hedge position. If I don't really have much conviction either way, then my default is to keep it hedged. But that's it for me today, guys. Thanks a lot for watching. I hope you learned something in today's video. If you did, please give it a like and I will see you guys in the next one.